to week 4, part 4 of the 10-part series. This week we're going to be heading to supply and demand zones. Next week we have covered calls, and the week after we go into the more advanced strategies. So supply and demand zones are really a combination of the channels from part 2 and the significant levels from part 1. Supply is where buyers or sellers are selling, buyers are buying, and demand. It's really the same as significant levels, only it's a range rather than one flat level, and then the channel is perfectly sideways. So the agenda for today is just what is supply and demand, getting into what that is again, the significance of it, finding supply and demand, and then how to use supply and demand. Do some live charting, then the Q&A and conclusion at the end as always. So supply and demand, as I just said, there's zones where the majority of buy and sell orders are active. Supply is where sellers are selling. Demand is where buyers are buying. Now, there's not just buy orders and sell orders at these zones. These are just where the majority of those buy and sell orders are. There's obviously constant buying and selling of assets in between. It's just that the majority of these positions are being bought and sold here. If we didn't have the buying between, price action would just jump from supply and demand zone, or we wouldn't have such a wide range between these zones. So supply is an area in price action where significant sell orders are placed. Yes, there is always buying and selling of shares, or else we wouldn't have that smooth price action in between. As I previously said, when broken, supply often becomes demand, price moves to the next supply zone, and then so on and so forth. It's the same concept as significant levels, same idea, same play type, only this, you have a zone that's about anywhere from 75 to 80 cents. It's because the order book, and you can see this if you have any brokerage, Webull, Robinhood, TD, Fidelity. The order book is what makes up the bid and the ask, and then you have your mid price, and that's the price of the equity at that time. And then you have your, I've heard people refer to them as walls or sell walls, buy walls. Those are areas in that order book where you can see just a massive jump in buy orders and a massive jump in sell orders. Those also make up your supply and demand. So you could not even look at a chart and find the supply and demand just by looking at the order block and the order books of whatever equity you're looking at on your brokerages. Demand is an area in price action where significant buy orders are placed. Again, there's always buying and selling of shares, or else we wouldn't have that smooth price movement. When broken, demand becomes supply, and then price proceeds to the next demand. This is when you have a downward trend. When you're breaking supplies, you have an upward trend. When I chart them, I usually just put them as red for supply, green for demand. Green because when we bounce off demand, we go up. Sell, red for supply because when we hit demand, or when we hit supply, we go down. Also because supply is people selling, demand is people buying. Just helps with the color coordination. So finding these levels, you're looking for an origin of a move and then the explosive move that follows. You can also look at just the order book on your brokerage. That works as well. You'll have to convert it to the chart yourself just by looking at the prices. I think Webull goes out as far as $2 on the order book and as far as 150 orders, depending on which plan you have. Same for TD and Fidelity. So on the chart to the left here, I have the supply boxes in red and the demand boxes in green. So again, what you look for is the origin of a move. So you want to see some consolidation, and this is where that channel comes in from part 2. As I said, channels are parallel lines where price action is confined between those lines. So you have a sideways channel, perfectly sideways. You have the price action stuck between two parallel lines, and then you have your break, and it's usually a very explosive move either way, up or down for supply, either way, up or down for demand. So when we're rejecting off a supply, we have that explosive move down right to the next demand level. A bounce up, this probably was a supply or demand level that I missed charting for this example. Bounce back down to demand, and then we have another explosive move after hours to the same supply level, same demand level the next day. So again, you're looking for the origin of the move, and then you're looking for the explosive movement. So these will give you small boxes at first. What you're going to want to do after you find those boxes is stretch them out horizontally until it reaches all of these supply zones that you have. So you can see that these are at the same level, 414.50 to about 413.50, and I'm getting that by the price action on the y-axis over here. So that is the two supply zones I had on that chart, and then I stretched it out so they touched each other. Same with demand, and then it continued on. But this is the basis of how you find supply and demand. And again, you play these the same exact way that you play significant levels, only for these you don't have a flat significant level. So on this chart you can see I have my white labels. So those are the significant levels I have that I leave on my chart once I chart them. And then something else to mention too, you'll see that supply and demands often line up with significant levels. So this one, the supply zone lined up perfectly with my 408.06 resistance, and the demand zone lined up perfectly with my 405 support. And this is from today's chart on SPY, Friday the 10th of February. So the main difference in your supply and demand zones are they aren't flat like significant levels. You're not going to have one main level to play. You can have a rejection at any level within your supply zone. You can have a bounce at any level within your demand zone. So the stop losses on these plays, they're a bit more than a stop loss that you would have on significant levels, because if you take a put below 408.06 in this example, because we had a candle close below 408.06, your stop loss is going to be a close over 408.06, whereas in this supply zone or in this demand zone, the price action can bounce anywhere within this zone. And in this case, it was 404 to 405 for the demand, and then 409 to 408.06 for the supply. So if you enter a put on the supply reject, your stop loss is going to be above 409. Say you enter at 408, you have all this leeway up to 409. So you may be negative 25, negative 30, negative 35% before you're invalidated. So this is why I don't prefer to play these, just because the stop loss is a bit looser, but they are significant, and you can play them just like you can play any other pattern or significant level for that matter. So we'll get into some live charting here now. And this example on this chart here was from today. So again, what you're looking for is the origin of the move. So you can see yesterday we had this could have been a pattern here. So this yesterday was likely a bear flag right here. It could also be a supply or demand zone. I don't have it charted as a supply or demand. What I do have is this block right here. So you want to go into where your brush tool is. I use the rectangle. You can also probably use any of these date range or price range. I think the rectangle does fine. So what I'm doing is we have the origin of the move here. So price action's confined between this channel. Bounce off the bottom, reject off the top, bounce off the bottom, reject off the top. Did that twice, and then it had that break. And the reason I have it charted there as well is because we have, again, the price action is confined between these two parallel lines, and then at the end of the day, we had one little rejection off of that level again. So that's the origin of the move, that explosive move down. And then I go ahead and stretch this box all the way out to the right. And you can alter it however you want. You move it up, you can move it down. Usually the supply zones are no more, I would say no more than $1.25 for SPY. And to get the percentage of that, just use your price range and move it up like that. So I'd say the supply zones are no more than 0.2%. And then for the demand zone, what we're looking for is, I'm using extended hours here. You can have two of them. So you can either chart a demand zone here and change that color to green for demand and say that's your demand zone. If you weren't using extended hours, I do use extended hours, so I move it back and I find the consolidation between my two parallel lines and then the explosive move up right to my supply zone. I move that down a little bit more actually. Explosive move up right to my supply zone, rejection back down. And then we just had consolidation between supply and demand today. But again, find that origin of the move, stretch it out all the way to the right, and then you have your supply and demand for the day. You can also alter them whenever you want to adjust it to fit the chart. So today we had a break yesterday, break down, explosive move down, retest of the supply zone, and then the market closed. Another explosive move down, opened and formed a demand zone here at low of day. And then we had an explosive move up right to that supply zone. And again, if you don't use extended hours, you can also adjust this up to here, 405.90 to 405.08. This will also act as a demand zone. They're just like significant levels where you don't have to be as accurate with these because it's a range, so you just have to be within, I'd say, about 50 cents either way, and you're fine. So I would say that this could also be a demand zone because of the wick, that using the wick from yesterday. It's kind of touchy because it could be either. We had that consolidation here right at pre-market open, a wick down at 10 o'clock, and then bounce right up to supply zone. Or you could use the wick from the previous day and use these intraday wicks today as your demand zone. But as long, you can see that there is overlap where I move these, it's about a 30-40 cent overlap. So that's where it comes into being within $1.25, $1.50 range. And then you can do this on any chart as well. So we can go over to Tesla here and do the same thing. So yesterday, go ahead and delete these trend lines. So we have that consolidation right here on Tesla, 212 to 211. So I get my box under the brush rectangle, draw the supply zone, red for supply, and then I can alter it to also include these wicks over here. So this would be the origin of the move. I draw it all the way out to the right, and we never touched it today, obviously, but I can draw it out. So we have origin of the move, consolidation between two parallel lines. We did have an initial break, and then it came back and retested it. This may be in part due to a chart pattern here. So we had kind of a descending wedge on the 5-minute that popped out. So they do overlap. I don't think that either of them is significant over the other. They do work together. But this is why you need to have those chart patterns under your belt to also recognize those while you're trading these supply and demand zones, because events like this can happen where, say you had taken puts at this supply rejection, we broke out of it to the downside, but we had a chart pattern underlying it that pushed us back up, and then we rejected off the top and supplied it again. So we go ahead and delete that chart pattern just so we have our isolated supply zone on the chart. And then you can also say that this little consolidation right here could have been in demand because we're confined between two parallel lines. It's also including the previous day, the lows from the previous day. So stretch that out, make it green for demand. There we go. And then those are your supply and demand zones for Thursday, February 9th. And then, as I said, when you have these demand or supply zones broken, this demand zone turns into the next supply zone, so where sell orders will be present. And then you're looking for your next demand. So we can go all the way back to Tuesday here and see there's quite a bit of consolidation right there. 197.96 to 195.30. Go ahead and make that green because it's below where we're looking right now. Stretch it out all the way to the right, and then you can kind of see how nicely it lines up with everything. So a significant amount of buy orders are placed at 196.67 on Tesla. This also lines up with a key support level, key resistance level, again depending on where the price action is. So we had consolidation, the origin of the move, explosive move down, bounce back up into the supply, explosive move down, bounce back up. We finally broke it, explosive move up, and we just happened to hit our next supply zone. Rejection, explosive move down, bounce, explosive move up, so on. And then we closed today within a demand zone on Tesla. So we broke the supply zone super early this morning, went right to the demand zone, rejected off of supply again, came back down, and then I can't explain the bounce off 193. I believe we had a Fed speaker at this time today between 12:30 and 12, so that could explain why we had the breakout here and then bounce right back up into it. But this zone here has now turned into supply because we did break below, and we're currently rejecting off of that supply zone. So if I had to predict what was going to happen just using supply and demand, I would say that this zone is likely going to turn into a supply zone, and then we can zoom out. Looking for our next demand, we see some consolidation right here. And this is a rather wide range on Tesla just because of how volatile it's been. So you can see a lot of consolidation here, explosive move up, and then we had several bounces off of it. And like I said, this is very, very similar to charting significant levels, only the main difference is that you have a range that you can chart rather than having to chart a perfect flat level. And then we stretch that all the way out to the right, line it up with the end of the demand, or the previous supplies. So we have consolidation, origin of the move. If you even pull it back a bit more, you can see some more consolidation on that supply right here. Breakdown to demand. Continued between both for quite some time. This 3 days where it chopped between both levels and then finally broke that upward supply zone. So if I had to predict what was going to happen on Monday, I would say because we broke this demand zone and it turned supply, we're likely, where's my tool here? We're likely going to have something like this happen on Friday, or on Monday, excuse me, where we'll move between these supply and demand zones again and then ultimately break out of one of them. And go ahead and stretch that out a little further as well. So that's how you get those zones. You're looking for consolidation areas of consolidation on the chart. And then you're continuing on with the bounces. Bounces and rejections, that is. And I can look at one more here. So I can go into QQQ. I can chart it from today. The other thing too is that you don't want to be trading when we're chopping between these supply and demand zones. So you want some nice upward movement, downward movement. Either way, you don't want to be trading when we're within the zone, because we can ultimately break out either direction. It's a very tight range, so you're likely just going to get theta burn, theta decay. So very apparent for today's chart on QQQ. Again, we use our rectangle tool. We have some consolidation here yesterday. So we have the origin here. Change this to supply because we're below. Stretch it out to the right. And then let's see if we zoom out. Not really anything over there that we can use. We can go all the way back to last Friday, 2 Fridays ago, actually. Consolidation here. This was supply at the time, but since we're above this price, we're going to change it to demand. And then go ahead and stretch this all the way out to the right. Hang with me there. And then if you see, it lines right up with today. And then we had this consolidation here, bounce off the bottom of that demand, and then we shot back up. Didn't quite get to that supply, but we are going into the weekend holding over demand. And as I said, chart patterns interact with these supply and demand zones, so it's not one over the other. They interact with each other. So if we go on the daily on QQQ, we can see that there's a pretty nice looking double bottom here. We broke the neckline of the double bottom, and we're currently shooting right up to the expected break, which is also previous resistance, 311, and then we're coming back down to retest the neckline break. So if I had to guess what's going to happen with QQQ, likely going to hit this demand zone, and because it's also interacting with a double bottom, these double bottom necklines typically retest and pivot from there. But we're also lining up with the demand, so I'm going to have to say that we're likely going to head up this coming week once we retest. We actually did retest that neckline today. So we're likely going to be heading up in the following week on QQQ, and that's just using the chart patterns as well as the supply and demand together. So for the homework for next class, I'll go ahead and say using SPY's 5-minute or 15-minute will both work. Find 3 sets of supply and demand, so 3 supplies, 3 demands, not including the one I already gave you. But that is all for what I have. These supply and demand zones, I'm putting them on the 4th course because they do interact with the previously explained significant levels, chart patterns, and channels and trends. So this is the next step after you have those 4 fundamentals those 3 fundamentals under your belt. After this, next week we'll be getting into covered calls, which is just a more so advanced strategy. And then after that, it just gets onto strategies rather than more fundamental practices. But that is all. Again, the homework for next class will be finding and charting 3 sets of these supply and demand zones.